a policy will get better and better no matter what. That's just incomparable. Hello and welcome to the Durham Talents channel. My name is Jesse Durham. This should be the last installment of part 1 in our book review of R. Nelson Nash's book, Becoming Your Own Banker. And this is a very exciting part because this is the part where he talks about creating your own banking system. So he begins by referencing Matthew chapter 25. It's an old parable about, suffice it to say, someone who employed 3 individuals, giving them a certain amount of money to be able to invest and work with. He was taking a long trip, and upon his return, he reconciled with each of them and found that one had been very productive, had doubled the amount that had been given to him in the first place. In fact, the same thing with the second, and then the third individual had just buried out of fear, out of hesitation, out of trepidation to do anything with that money, had just buried it in a hole in the ground and went and dug it back up upon the owner's return and gave that same original amount back to him. And he said, you know, at the very least, you could have taken this to the bank or the money changers and I could have gotten some interest on my money. At the very least. Not investing it, not using it, not necessarily even multiplying it like the others, but I mean, the least I could have gotten was some interest on my money while I was gone. So, very interesting, of course, that Nash points to that scripture. He then gives us the definition of banking. He says, banking is, and this is according to Webster's Third New International Dictionary, the business of a bank, originally restricted to money changing and now devoted to taking money on deposit, subject to check or draft. These are all familiar words to us so far. Checking account, savings account, we deposit. Almost everyone now has deposits that just automatically, electronically go to the bank first. But check or draft, loaning money and credit, and any other associated form of general dealing in money or credit. So there's some scripture to give us a historical reference point. Also, the actual definition of what it means to be banking. And we've already looked at commercial banks, how they work, what they do, and we've arrived at, well, how can we create this privatized banking system for ourselves? Because to be sure, there's an easier way than all the groundwork that we discussed in the prior video. So we need to start by recognizing that we do finance everything. We do indeed finance everything. Either we pay interest to someone else like the commercial bank, as we have already seen, and the average American is paying massive amounts of volumes of interest, or we're just bleeding out interest to conventional banks. Or, for my cash is king folks that set aside money somewhere, capital somewhere, either we're paying interest to someone else for using their money, or we're forfeiting the opportunity to earn interest on our money. Much as we saw in that parable, the opportunity to have earned interest at least on the capital was missed. So one or the other is going to take place. Now, let's start by addressing a very common saying that I've adopted now from R. Nelson Nash, and that is that when you know what's going on, you'll know what to do. When you know what's going on, when you're aware, you'll know what you'll want to do, therefore. Now, let's begin by looking at engineering. Engineering is taking place from page 21 on over to page 25, I believe it is, as a recurring theme to remember in creating your own privatized banking system. And it's easily relatable if we consider cars, for example. Now, if 2 individuals buy 2 identical cars, meaning same make, same model, they came off the same assembly line, they were engineered, follow my train of thought here, and from what Nash is showing us, came off of the same assembly line and everything. Does that mean that the performance of those 2 vehicles over the following 5 years will be the same. Now, let me ask one more question on that. Do you know somebody that is just taking immaculate care of their vehicle? And don't you probably also know someone that just trashes, just runs stuff into the ground that they own? All right, so they're both out there. So naturally, the performance of those two identical vehicles can be vastly different depending upon who. Well, again, and that's so good because this is the idea that you can become your own banker. Okay, so you are the mitigating factor. So let's look then at the engineering of a policy, because just like a car can be treated well, treated poorly, even though it's made and engineered the same can happen with a policy depending on the owner, the user. But let's talk about the engineering of a policy. What happens is that actuaries study massive amounts of lives, selected lives. That's important, selected lives. Just like you go through a medical examination, for example, to be able to ascertain your health and different things, age, sex, to be able to determine your eligibility for a whole life insurance policy. Well, the actuaries beforehand looked at millions of selected lives over a very long time frame, meaning nowadays, there are products for up to 121 years. So 121 years. Nash in his book says 100. There are also policies that are 100-year contracts, to be sure. And these millions of lives, select lives, that are looked at over such a long time help the actuaries to arrive at the actuarial information that they need to be able to write products. They give that information to the rate makers. The rate makers determine a cost. What would it cost to deliver a product to a population based off of this actuarial information? That's turned over to lawyers who put it in legal, binding contract. And then that's offered to a population through a sales force, through representatives, agents. So the owner in this entire scenario, Nash points out, is the most important character. First in line, most important. The actuaries have done all the actuarial accumulation of information to be able to determine what they will need to provide in a product. The rate makers can put a cost to that. The lawyers write it up into binding contract, and then a sales force delivers those contracts, makes them available to potential buyers. Now, the owner is the one who is also going to be making the deposits. And I say deposits, but that's going to be interchangeable with premiums. So actually, in fact, premiums are paid by the owner. But again, in this mentality of what it means to create our own entity, create our own privatized banking system, we also need to view those premiums, those premium payments, as deposits into our privatized banking system. So when a owner pays a policy premium, the insurance company has to do something with that money, obviously, to be able to meet those guarantees that they have put in that contract of cash value, death benefit, everything that's in the contract, to be able to satisfy what they have contractually, legally bound themselves to do just by us paying a premium that we've agreed to pay. So they have to put that money to work. Now, again, the owner is the most important person. The owner, in fact, if you'll look at the contract, will be first in line. Will have primary access to the cash value in that policy. Whereas otherwise, the company would be using those funds for very conservative things like long-term mortgages, such as bonds, very conservative items, as well as other joint ventures or real estate investments. It's possible to look at what a company is investing in, how they're putting that money to use. Again, traditionally very, very conservative in going the route of bonds and mortgages, but also partnerships, joint ventures, real estate investments that come along as well, where it makes sense for an entity as well capitalized as a whole life insurance company that's been around for over 100 years, that would make sense for them to be able to participate. So otherwise, the insurance company will put that money to work in the mortgages, bonds, real estate investments, etc. if the policy owner doesn't access the equity first, because the policy owner will have primary access to the equity, meaning the cash value in the policy first. They're first in line. Now, it's necessary to know, too, that by purchasing a whole life insurance policy with a mutual company, that the hired help, meaning the employees and the personnel from the insurance company, will be paid from the owners of the company, which would be the policyholders. So the hired help is being paid. The beautiful thing about that is that the cost there is prorated amongst all of the policyholders. So you have all access to home office personnel. That's already covered. So there's a system already in place that we can simply tap into. By paying premiums into a policy that we own and control, we immediately have access to all of the hired help from the insurance company. Now, in speaking more about engineering, Nash, as an avid aviator, talks about airplanes frequently in his book. And what he talks about is going into an airplane, taking a look in the cockpit, and seeing on all the different dials that there's commonly a dial that reaches a red portion of background, meaning that that's a warning that we're getting into a stressful area of whatever the case may be. Let's say it's ground speed, is what he said in the book. A ground speed that's beyond what's recommended for that airplane. But the engineers have overbuilt that airplane, and he says 20 to 30%. Now, I, not as an aviator, am perfectly satisfied to stay within the white lines of the gauge, but I know that Nash was speaking from a place of authority, being an avid aviator from basically childhood himself. And he referenced that 20-30% past, what's recommended, even in the red, because the engineers have overbuilt that. Now, that's not to say that cumulatively that overstressing that system couldn't result in a crash, because it could, to be sure. Nash points that out in his book. And yet, it's beautiful to recognize that this has been overbuilt, this airplane. But also, what we're going to see is that policies and the design that backs them up has also been overbuilt. And it's terribly interesting. So, much like airplanes, policies become more efficient over time. Every year that policy premiums are paid, that policy becomes more and more efficient. Because, again, keep this in mind. If day one, you have a cash value of X in your policy, and ultimately, the policy must culminate when it matures in a face value of multiples of this number, then every day it must grow and grow and grow and grow uninterrupted to eventually arrive at that face value, whether that's $500,000 or millions or whatever the number is. I don't want to get caught up in the number. Decimals move left and right, but there will be this continual upward growth trend from day one, on weekends, on holidays. So when we recognize that the policy is going to be more efficient over time, let's compare that to an airplane. Because what Nash says is, let's say an airplane has a power of 10, and then this is just me using layman terms. Let's say an airplane with a full tank of fuel on the ground on its first takeoff has a power of 10, but it's also weighed down with a full fuel tank. Well, after its second, third, fourth, however many flights, as that fuel has been used, Let's say 20% of the fuel has been used. Well, think about this. The airplane still has the exact same amount of power. It's still got that full level 10 of power, but it's got 20% less fuel to have to carry. Now, isn't it going to go faster and further, weighing less? Absolutely. So, and as that continues, as half of the fuel tank is used up, and it's literally carrying half of the fuel that it was prior, but it still has the exact same power, isn't it going to be even more efficient? Absolutely. So the efficiency of a policy, much like the efficiency of an airplane, continues over the course of time. And what Nash says is this idea of getting better no matter what is just unheard of in the financial world. But that is exactly the case, that from day one, there is a continual upward growth trend to a much, much larger number, no matter what. Now, again, this is going to be ultimately coupled with what we've already said here from this section of two cars, although identical, their use can be very different, right? Just like the red gauges on the airplane, cumulative overstressing, not good. Can you even ruin the best business in the world? Like we talked about in the last section, the banking business. Yes, you can even run the best business in the world into the ground. But the idea that in and of itself, because of its structure, a policy will get better and better no matter what, that's just incomparable. So a point of impact here is that while policy premiums are paid, it is necessary to remember that loan repayments with interest at market value or better than market value is what makes this entity, this system, this way of using whole life insurance for a privatized banking system. That's what makes it better no matter what over the course of time. Now let's talk about dividends. Starting on page 23, we see the mention of dividends and how, yes, a dividend is not guaranteed, but also when a dividend is declared by a company, and that dividend, let's say, because this is what I would most commonly recommend, like Nash, that a dividend be used to buy paid up additional insurance. Once we realize that the non-guaranteed dividend, once it's ours, and it buys additional paid up insurance, and again, it could do other things there, but let's say it buys paid up additional insurance. The dividend that went back into the policy itself now makes a value that cannot go down. So it grew the value of the policy. So it grew the death benefit of the policy. It bought paid up additional insurance, which also therefore inherently means that there will be a greater amount of cash value accessible. So we have a non-guaranteed dividend, but once it's awarded, the value of it can never go down. So we have this ever-increasing base of a death benefit and therefore an ever-increasing base of cash value as well. So a dividend is not guaranteed, but once it's declared and you've received that and it either comes to you in a check, the company can just mail you a check, you can have the cash money. But if you use that, again, advisedly for buying paid up additional insurance, then the death benefit just grows, the cash value just continues to grow, and it cannot go back down from that. In contrast with securities, let's say, and Nash very well points out how ironic, almost an oxymoron it is, that stocks are called securities, and yet securities are not guaranteed to not go to zero. So a dividend that's not guaranteed when awarded, and again, I have multiple policies with multiple companies. I'm not married to any individual company, but they've been in business and been paying dividends for over 100 years. So it's not guaranteed, but again, once it's declared and you've assigned its task, and if it's bought paid up additional insurance, your death benefit grew, your cash value therefore grew. It can't go down from there. Whereas securities, there's nothing stopping them from going to zero. Also, Nash makes a point about Social Security, the Social Security program, how regardless of what you think or anticipate, whether you're already receiving something or not receiving something, whether you think there will be anything there to receive in the future or not, whether you're paying into that of your own volition or not, regardless, think about this concept. I'd never thought about it until I'd read it in Nash's book. Social Security has no market value. Even with what I just said about securities, it may have a market value. Stocks may have a market value. Now, it may go up, may go down. That's out of my control, and I'm not a big fan of that being out of my control. If you are, that's fine. That's great. But consider that Social Security has no market value. Even whole life insurance. There's a market for whole life insurance. I mean, there are lots of folks who, for whatever health reasons, are not able to get a policy for themselves on themselves, but they're willing to buy permanent life insurance on someone else. Now, what we need to recognize about this dividend is that it is, in fact, a return of premium. So as we've spoken about engineering and overbuilding, the actuaries and rate makers, when all of this has come together for them to offer a product, have overbuilt where more is collected in premium than is necessary, absolutely necessary, to provide for all of the death benefit claims over the span of time, and also to be able to do well by the cash value and providing that the owners have first access to that cash value. So with that being said, when a company declares a dividend, they're declaring on their general performance of the year. And more capital was collected from the policy premiums than was necessary, again, to satisfy death benefit claims, etc. So that there is no, according to the IRS, which was formed in 1913, the IRS. Also note that life insurance has been around for over 200 years, predating the IRS by a good bit. However, a dividend is a return of premium. So this return of premium is extra capital that was not necessary to meet all of the obligations and legal requirements to pay death benefits, etc. And it also accommodates for downer years. So think again with a long-range mindset like Nash encourages us to. These companies have been around for a very long time, and they look very far into the future as they're buying the things that they do with capital, 30-year mortgages, 30-year bonds, etc. They're playing a very long game because they can. And to be sure, they don't want to be undercapitalized in doing so. But again, based off of the general performance, they can declare a dividend from their general performance. So technically, it would be classified by the IRS as a return of premium. So it is not a taxable event. So think about the beauty of that. You receive this return of premium, this dividend, that allowed the company to be capitalized enough to accommodate for any downers, any downturns, all while still meeting every single one of their obligations, and also, in fact, still being able to have a return of premium, pay a dividend, that then can buy additional death benefit, which therefore provides for a growing and ever-growing cash value. Overbuilding, from the engineering standpoint, enough was collected to keep a company out of danger from a downer year and still have a return of premium, a dividend, go back to the owners of the company, the policyholders, who then can use that to procure an ever-increasing base of death benefit and therefore then cash value. That, my friends, is the beauty of the engineering of properly structured whole life policies with a mutual company that pays a dividend. And that dividend actually, in fact, allows you to buy paid up additional insurance that there is no cost of acquisition. Meaning that's done internally. There was no sales commission that was paid from that dividend. That's all happening internally. No cost of acquisition. That's huge. It shouldn't be understated. And Nash, in his book, in this section, does give us an insight into a 1959 policy that he had. I believe it was State Farm, where the dividend that he earned was over 10 times what the premium, the annual premium was for that policy. So listen, Nash reduced his premiums for the first 15 years. First 15 years, he did not buy paid up additional insurance with his dividends. He used the dividend to reduce his premiums. Then, so for 15 years, but then later, of course, he realized the beauty of that ever-increasing death benefit and cash value by using a dividend to buy paid up additional insurance, and started doing that. But regardless, that 1959 policy that was not run as well as it could have been, again, going back to user, okay, the user, 2 cars example, even with that being said, there came a time where he was receiving a dividend that was 10 times the amount of what the premium dollars were on an annual basis. So just real quickly, imagine a machine and you put $1 in and $10 come out. What a wild phenomenon. Where else can you do that? And he said very clearly that the sales force, the home office folks, they do not sufficiently cover, they do not adequately cover all these aspects of what whole life insurance can do. Now, everything that we've covered so far has been what Nash determined to be the easy part, the simple part, the straightforward part. The more complex is what we will cover now as he begins talking about the average American. Now, the average American, when sitting down, let's say, with even the traditional life insurance agent, is going to end up covering human life value. We'll figure out what kind of income is earning, what kind of income is expected to be earned over the next 30 years, let's say. Let's take a 20-year-old individual just for a theoretical example. What kind of income can we expect to make over the next 30 years? And we can calculate what kind of a death benefit we should acquire for that young man to be able to replace, to be able to offset the risk of his early demise. And we can arrive at a number that we would want in death benefit. Now, when we can recognize that that same All-American is paying around 35%, remember the money problem, 35% interest of every dollar that he earns, his need for finance is even greater than his need for protection. So, sure, we should start with coverage. We should start with protection. We should get life insurance, permanent whole life insurance with a stable mutual company that's been paying a dividend for years and years and years. But our need for finance is even greater. So as the agent is sitting down with this young man and saying, well, okay, let's say theoretically, like Nash describes in his book, and we're at page 24, that the young man is paying $50 a month for his insurance, life insurance, and he would even determine himself to be insurance poor at that point, saying, well, I'm worth more dead than alive. He's starting to feel like the lead actor from It's a Wonderful Life. And he's saying he's worth more dead than alive. But he's also paying $260 in a car payment because, well, that's what the average person is doing, right? So $50 to a life insurance policy, $260 to a lender for financing a vehicle. What's happening here, because he did that with a bank. So while the finance company lives very well off of that young man financing a vehicle with the commercial bank, he doesn't recognize that he's paying both of those amounts to the same pool of money. Remember, Nash talked about there's only one pool of money, just like there's only one system of water in the earth. The rivers, the oceans, the clouds, it's all one system of water, one pool of money. So the $50 to insurance and the $260 to the car loan are going to the same pool of money. Let's talk about how that is. Nash says if this man could take a step back to gain some new perspective, if he could detach to be able to look at his situation. He would recognize that both of those amounts are going to the same pool of money. And how much more likely is he to complain about $50 for this life insurance while not recognizing that it's going to the same pool? Because what's happening is, if we would say that $310, the combined $50 plus $260, the $310, what if that were paid first instead to a policy that this young man owned and controlled? And let's say every 4 years, okay? So let's say after 4 years, it was time for that new vehicle. He could have the cash value that he could take a loan against from the insurance company, from his policy. So that capital would be there at his access to be able to go out and pay cash money for that vehicle. So keep the money going to the same one pool, the $50, the $260, the $310 all together, into the one pool, but just make it to a policy that you own and control first. And then after the 4 years, you have access to the cash that you need to go out and just pay for the car. This is where it's important to recognize that the agent should be speaking about repaying the loan, and with interest, with an interest that is at least comparable to the market. Now, I know that both in Nash's writing and today's day and time that there's talk of 3%, 2%, 1%, 0% financing on things. Remember this, folks. The customer pays for everything. The customer pays for everything. So a real market value of interest should be paid back to your privatized banking system, or even better. What if you valued your capital better than others even? Because again, remember, it's going to an entity that you own and control. This is your privatized banking system. And what the agent may come across is, if this young man says, well, that's my money. I'm not going to pay to use my money. And that's a common phrase in the financial world today, just like it was back then. The agent should remind, it would be my job, to remind the prospective client or the client that the grocery store applies here. If you're not a thief, don't steal the peas. And if further remonstrance is needed, let's go back to the First National Bank of Midland, Texas. And then what Nash says is, well, if those two examples don't bring us to an agreement on how to sufficiently practice the infinite banking concept by being an honest banker, then you're either working with somebody who is unteachable or a thief, neither of which are conducive to the relationship. So he just says, resign yourself from working with that individual, because they're a thief or they're unteachable, one or the other. And that's good and familiar language to me, because what I've recognized over the years is that a closed mind cannot learn. If somebody is an unteachable person, you can't help them. And if they are decidedly going to walk out the back door with the peas, or apply the same human errors that we see in the First National Bank of Midland, Texas, where the owners are making loans to themselves, not paying it back, not paying interest, doing speculative things with it, well, even the best business can be run into the ground, Nash says. So you're either going to be working with a thief or an unteachable person, neither of which is conducive. So what I've grown to understand as a professional myself in this realm of mentoring folks and coaching folks as a professional is that I don't need any one person as a client. And there are plenty of folks who would probably decide, even after having a discussion with me or a webinar or a meetup, that I'm not the professional that they would like to work with. And that's fine. I believe that the individual should find the professional that's practicing the infinite banking concept themselves, that has a system of policies that they're using to satisfy their need for finance, that is following and practicing infinite banking as described in Nelson Nash's book, Becoming Your Own Banker. The way that the guy laid out in the book. And that's why we're doing the book review. And that's going to make sense with who it makes sense for, and that'll be great. I look forward to connecting with you. Now, Nash talks about capitalizing for at least 7 years. Folks, we have to have a long-range mindset when we approach the infinite banking concept. Again, think about what went into building the grocery store and getting open for business. Think about what went into opening up a commercial bank. This capitalization is one of the bigger hurdles, I believe, mentally, one of the bigger hurdles for someone to understand. I think that business owners actually grasp it quicker than a lot of other folks. It seems like sometimes the majority of my clients are business owners in some form or fashion, small business or what have you, because the capitalization phase is necessary even for the best business in the world. So don't be the only customers. What Nash says here, capitalize. Don't just capitalize for a year, 2 years, 3 years, 4 years. Capitalize for several years so that not only you can be the customer in your grocery store, but that others can be customers in your grocery store. See, this should be a system of policies, not just Nash clearly says that this is on page 25. This is not just a policy. This is going to be a system of policies that will accommodate for your entire financial footprint. So not just for you, but for children, for a spouse, maybe parents, other family members that will come to your grocery store, that will benefit from your privatized banking system. This is a way to be able to keep the money in the family, in the business, in your own investing portfolio. So it will be a system of policies, much like a grocery store is going to have chain locations in different towns, different cities, just like a commercial bank is going to have branches in other towns or more in the same town. If they're successful in one place, why wouldn't they be in another? So what you will build over the course of your lifetime is a system of policies that you own and control and that you use to accommodate your need for finance. And ultimately what that means is that you will eventually max out your own personal insurable interests. You will get to the point to where you couldn't get any more policies underwritten for yourself. Now, again, we're talking long term here, but it's possible. It's possible that your income equal your premiums over the course of your life, that your premiums equal your income, that those two numbers are the same. And in fact, when you take in dividends into consideration, you can have more in premiums than even your income. But also, Nash talks about, in building a system of policies that you will be looking to ensure all of those that you have an insurable interest with. My wife and I have 3 policies in underwriting right now ourselves, one for each of our children. We already own 3 different policies that we've used and acquired over the past several years. And next for us is getting a policy on each of our children to add that to our system by getting them coverage, but also adding to the family system. And doesn't indeed all of your income go through a commercial bank now? So many folks already have just automatic deposits going to a commercial bank. So think about that when thinking about getting eventually over the course of time, your premiums to equal your income, for those numbers to be the same. Now, Nash does say, to bring a breath of fresh air to this, it may take the average person 20 to 25 years to accommodate for their entire need of finance as a household or as a business or what have you. But again, my thought there is, wow, that seems like a long time. In a way, there's a part of me that says that still says that, even after years of practicing the infinite banking concept myself. And yet, what I know is that that's a battle that everyone has against this instant gratification, that we want to do something right away. We want to go, for a lot of folks, it's cash on cash right away. They want to be able to have in cash value year one exactly the premiums that they are paying. It doesn't work like that. You need to be able to capitalize a sufficient system for yourself. And the time is going to go by either way. Remember that. If you're vetting this idea of the infinite banking concept, and you're obviously doing your due diligence by watching a book review and you're reading a book and we've had a conversation or we're going to have a conversation, you're doing your due diligence to educate yourself on what it means to become your own banker. Remember that the time's going to go by either way. 20 years is going to go by either way. The question is, will you or will you not be better off if you practice being your own banker? And the light at the end of the tunnel here is going to be that once a system is built, it doesn't have to start from scratch again. See, for future generations, the death benefit of a system of policies will be a tax-free transfer of wealth. So it can set up for a completely different starting point than for somebody who's vetting this idea right now or just in their first years of practicing the infinite banking concept themselves. So starting on page 26, Nash summarizes with some basic understandings. He says, 1, that you finance everything. Either you pay interest to someone else or you forfeit the opportunity to earn interest that you otherwise could have earned. 2 is that creating an entity means having a plan, having control, ownership, access to equity, putting yourself in a tax advantage, meaning you'd have tax deferred and tax-free options with a properly structured policy. You can make it to where compounding is never interrupted, and in fact, you would have an ever-increasing base of death benefit and therefore cash value. And then he gives a review on page 27 where he covers 6 topics. The first is imagination. Remember Gauss, the famous young mathematician who discovered something about a fixed mathematical equation. It already existed, but he discovered that it was there. And what a difference that meant for velocity. I mean, you'd be amazed at the velocity. Even though you begin with a long-range mindset and you realize that there's going to be a capitalization phase, you would be amazed at the velocity of what you can accomplish by accounting for the banking function in your life. The grocery store, capitalization, cost management, ownership, and also being a consumer. So the grocery store example, that's going to be a concept that we will carry throughout this entire book review and that you will carry with you throughout your entire lifetime of practicing the infinite banking concept. We must remember the grocery store. Don't steal the peas. The money problem. What we're doing with after-tax dollars is bleeding out interest to others. That's dollars, that's money that will forever leave us, never to return. And those folks are living well off of us. So we must account for that. We must account for EVA, the economic value added. Our capital has a cost. Number 4, banks. Like a grocery store, but it costs more. It's more difficult to get there, but ultimately it's very, very profitable to own a commercial bank. But you can't steal. Remember the First National Bank, Midland, Texas. 5, whole life. Ultimately, we just need to recognize who the characters are in the play. There's a play taking place. Who are the characters in the play? Who controls your need for finance? Who controls the banking function in your life? And then 6, the capitalization phase. And again, I do think that this is perhaps one of the strongest hurdles for us to be able to mentally overcome, that we must capitalize this system. But it's absolutely necessary. So read the book, reread the book, dive in on as much information as is necessary for you on our channel to be able to understand the necessity of capitalization. And then you will be the beneficiary of it. Because it will take years, but it's worth the effort. So I hope that this has been helpful. This section of part 1 in our book review of Becoming Your Own Banker by R. Nelson Nash. I look forward to the next parts that we're going to cover because we've just now actually started getting into, we've laid the groundwork, and we're just now starting to get into what it means to practice infinite banking. So leave a comment in our comment section on what's been the most invaluable nugget to you so far. And if you'd like to have a conversation about what we've covered here and figure out how you could apply the infinite banking concept to your household, your business, your investing, then you can reach me at 828-817-4223. Or you can email durhamtalents@gmail.com. This has been a great pleasure for me. I look forward to our next conversation. Have a great day. Take care. Very conservative things like long-term mortgages, acres, when all of this has come together for them to